Hi everyone, this is May Katsevman from PrepFormula. I'm just doing a quick sound check to make sure you're able to hear me. Let me know if you can hear me just by typing in a quick yes into the chat box on the right side of your screen. Let me know if you could do that now, just to make sure that that I'm able to communicate effectively. And let me know if you're able to also see the screen. If you're having any challenges whatsoever, please let me know. Okay, great. Thank you very much. I will let you know that during this webinar, if at any point in time you are faced with a technical difficulty, we are using Google to transmit this information and this entire webinar content. So if you just go back and refresh your browser using that same link, you should be able to come back right into the case and right into the webinar. And so if at any point in time, for some reason, if you lose audio or video, you just refresh and you'll be able to come right back. Okay? Great. We're going to be beginning in about 2 minutes. I'm just going to give a few more minutes. I'm noticing we're picking up steam. So I just want to make sure that people are able to follow along. Hi, everyone, and welcome to the Canada Heavy Engineering Incorporated Debrief by PrepFormula. This is a debrief on CHEI made by me, Mike Katsevman. I'm the course director at PrepFormula. And I just want, before we start, I want to explain the purpose of this webinar and highlight a couple of copyright issues that I'm legally obligated to discuss. The case in this debrief is the Capstone 1 case produced by CPA Canada called Canada Heavy Engineering Incorporated. It's publicly available on the CPA Canada website, accessed on January 12th, 2016. The copyright of this case belongs to CPA Canada and other provincial bodies. It does not belong to PrepFormula. The interpretations, however, that you'll see below and during this webinar content are my own opinion, and all rights are reserved. The opinions below are my own, and they're not to be relied upon, so it's not advice. It's what I'm doing is simply providing a way to debrief the case for illustrative purposes, and they're not advice or guidance. And just to be also clear, PrepFormula is not affiliated or related to CPA Canada, CPA Ontario, or any of the other CPA bodies. We are a separate supplementary service. And our activities have not been approved or endorsed by CPA bodies. Okay. Like I said, I legally have to provide that kind of a disclaimer. So it's important for me to start off with that. What you'll see is obviously there's no answer available for CHEI, and really the main purpose of why I did this is because there were a number of people that reached out to me that had a lot of difficulty trying to go through this case. With my own experience with these long cases has been that they try to cram as many possible things into these cases as possible to try to really test your ability and see if you're able to follow along with all the most kind of challenging parts. So again, what I'm going to be covering here is a debrief of the first part of the case. So I'm not going to be covering the exhibits because there's just not enough time. I could spend all day talking about this case. The most difficult part that I found while reading this case was the first 23 pages or so, and that's what I'm going to be covering here. Everything else is just simply an extract. So the way after you read the first 23 pages, what you'll notice is there's going to be things for you to do. So these are going to be the requireds, the assessment opportunities that you'll have to work on, and the exhibits is where you find more information. But the way that the case is written, you may have noticed that some paragraphs are scrambled. So it's completely jumbled. One paragraph might relate to one topic, another paragraph might relate to something completely different. So this is my attempt to at least try to help you think about ideas that you should be thinking about while you're debriefing this case yourself with your group. And hopefully it'll be a little bit clearer after this. I'm going to be using this little tool over here to be able to highlight information, right? So see this little red kind of marker that I have. It's almost like a pink color. I'm going to be just highlighting some of the key pieces of information. I'm your session leader for today. For those of you that don't know me, I'm May Katsevman. I'm the director. I'm the course director of PrepFormula. In the past, I've also been a CPA marker with CPA Canada, and I've marked the 2014 UFE, and specifically, I've marked the long 5-hour case, which is exactly what kind of this case is based off. I'm also a CPA mentor in the province of Ontario, and I do work for PrepFormula as well on a one-to-one basis as one of the markers. In the past, I've been involved with as a UFE prep marker for York University's Atkinson program, and I've been involved with the UFE prep process at ENY, which is where I initially obtained a portion of my designation through. Why PrepFormula? Again, for some of you who don't know what we do, PrepFormula provides a supplementary personalized training program. So we're entirely one-on-one based for students going through the CPA Canada professional education program, and we pair students with CPA markers on a one-to-one basis. We're also certified as a designated post-secondary educational institution by the Ministry of Employment and Social Development in Canada, which means that we offer a T2202A tax deductible receipt for all course fees paid. We had an 89% pass rate for students enrolled in our program, and as of October 2015, PrepFormula is the largest and most trusted CPA prep program in Canada, based on site traffic. So the start of the actual debrief. Why don't I kind of start and jump right into this? If at any point in time I'm going too fast and you're unable to follow along, please note that there will be a video replay available at any point in time during any future event. So at a later point, you'll have an opportunity to rewatch this entire webinar as many times as you need to be able to really extract. But really, in this particular webinar, I'm going to be focusing a lot on the competency map. And the competency map is kind of a rule book that sets out the generally tested areas that you're responsible for. And you should be aware of the 6 technical competency areas, right? Which I hope you already all know by this point. FR, I usually like to use acronyms. So FR is financial reporting, strategy, and governance. You'll see a lot of SG. MA for management accounting, audit, and assurance. I typically use audit or assurance in my notation. F for finance, and T for taxation. And for someone who's coming in from some of the legacy designations, what you may notice is that there's these new enabling competencies. They're not really necessarily new. They're really an extension of something that was borrowed from the CMA process, and it was elaborated on in addition to something that existed under the old CA legacy process, which was called the PQs, the pervasive qualities, right? So this is kind of the higher level. So the idea is and this interrelationship is everything we do will be focused on combining the enabling competencies with the technical competencies, right? Okay, all right. Who are the main users in this case, and why is this really important? What I want to demonstrate here is you are not doing an audit. So some of you that are coming into this program are probably thinking, what is the point of this case? And a lot of you may come in with an audit mindset because most of the practice cases in the modules are audit level cases. So in other words, you are always acting as an auditor. In this case, I want to make it extremely clear that you are presenting to the board. A lot of the findings that you will see are going to be negative. So it puts you in a really difficult and conflicting situation because on one hand, what you'll notice is there are huge challenges. There's absolutely huge challenges with respect to there's huge challenges with the respect to some of the control weaknesses that are present in this case, and there's a number of other areas that are significantly weaker than where they should be, and I'm going to go through the exact requirements. But the key takeaway is you can't bash these people too hard because you are presenting your report to them. So you are not an independent third-party auditor who's required to perform and provide an audit opinion, and you don't necessarily care about what the client will think because you're doing the right thing. You are directly hired on behalf of the board of directors and management to suggest an approach. So that creates a huge challenge. Okay, so all right, let me start off by identifying some of the assessment opportunities that I think I saw here, including with the actual, what I've done is I've tried to lift the exact sentences out of this case, and I've tried to summarize where they're at, where you can find them, which technical competency I think they're talking about. Again, I don't have the answers for this. This is just my interpretation. Some of the enabling competencies that might apply, right? And then I've ranked in some kind of a way. I don't think that you're supposed to rank in any way. The idea is for you to consider talking about as many assessment opportunities as possible. Okay. Let's talk about the first one. I would like you to engage CPS to analyze CHI in its current state, identifying the issues facing the company and making useful recommendations where needed, including mission and vision statement update. So this is kind of a part that was lifted from another part of the case. I've noticed that the first assessment opportunity, or what is known as a required, was in S&G. And there was a couple of enabling competencies that related to problem solving. So this is your discussion of the vision and mission statement, along with the general future direction. Okay, so this is like a formal conclusion that you have to provide. We can ask CPS to also give us input on hiring an internal auditor. Is it a good idea to hire an internal auditor right now? If so, who should be hired and what should they do? Perhaps a couple of intelligent people from finance or engineering would be interested in it in a 2-year secondment as internal auditor. Anything relating to audit, I'm immediately thinking that this is linked to audit and assurance. Any of the enabling competencies, it's directly related to professional ethics and ethical behavior and general communication. So you have to provide advice and you have to explain. The next is I would like I would also like advice on any important financial reporting and tax implications for the Klang Bridge and Highway 507. I divided these up into two different components because technically they're asking for both. But the way that this would be evaluated is in two separate buckets, which is why I divided it up and I put the financial reporting here and the tax over here. So really, the competencies will be FR and tax. And here we've got the same enabling competency of basically problem solving. And the next one is prepare an assessment of whether CHI should adopt IFRS. Technical competency FR, and you want to discuss some of the key differences, say between ASPE and IFRS, and it's really communication. There were 5 more that I noticed. I'm also interested in the general thoughts regarding proprietary nature of our asphalt maintenance wear and ice frost damage predictor algorithms. Now we're talking about potentially an FR piece with an MA link, right? And you're solving some kind of a problem. Because it's proprietary, it's the FR link, the intangible side of it. Because it's and management accounting comes into play into the algorithm idea. So how do you establish an algorithm for something that's valid, right? So this is like part of the actual prediction. I would like them to have a look at our current dashboard reporting and propose a way to update it. So clearly, this is a more of a kind of a management accounting / audit and assurance competency where you're required to assist them obtaining the right information at the right time. Again, problem solving, teamwork, and leadership are the enabling competencies. I've also heard that companies our size utilize performance measurement. So this is kind of a more of a requirement for performance measures. So I see this is a clear management accounting discussion. And also professional ethics and ethical behavior, problem solving, and decision making. These are the enabling competencies for that. I would be interested in hearing CPS thoughts on some of our tax concerns. So clearly, a taxation technical competency with the enabling competency being problem solving and decision making and communication. And then there's this kind of vague point on page 20 where they say consider the 4 new projects. When they say 4 new projects, they want you to provide an explanation on whether they should pursue it or not. The way for you to do that would be through a finance approach, where you would look at and try to calculate some of the kind of the quantitative side and the qualitative side of the actual discussion, and that's where you would address that. Okay, you ready for the interpretation? So what I want to do now is to go through the case. And I want to be able to explain it in a way that you can take something away. I'm going to run this webinar up until about 2 p.m. Eastern Standard Time, at which point we'll have a quick 5-minute break. And I'll get to your questions. I know that there's a lot of questions that are already being asked in the actual chat box on the right side of your screens. If you're watching this on YouTube instead of the Google Plus Webinar Jam software, then you may not see the comments. You may only see the actual video link. So I highly recommend for you to actually use it through Webinar Jam, because then you'll actually end up seeing the comments and you'll be able to participate in the discussion. Okay. So without further ado, let's jump right into it. Okay. So this is the first part of the case. What I'm going to do is just go paragraph by paragraph and explain what I see and explain what I think you should take away. I'm also going to highlight some of the competency areas that I think you should be picking up while reading this case. If you have any additional thoughts while I'm reading, and if you think I'm missing something, there's a chance that I may be missing components here. And I also want to say that it's really impossible to hit every single point, which is why a marking guide typically has more types of issues than what's possible. And my intent here is not to provide a complete response, but to focus on the most important issues. So I just want to be clear that this is not a complete, like, I'm not doing the work for you. I'm not here to kind of to tackle the case and produce an answer. I'm just here to assist with the reading and to assist you with this overall process to help you understand this case a little bit better based on my own experience as a CPA marker. Okay. So if we look at the first paragraph, you're provided a date. Typically, the reason why a date is useful is that it provides a bit of a timeline. And as you can see, it's your second week on the job with a management consulting firm. And you've been assigned to develop a report to the board of directors and the management of Canada Heavy Engineering Incorporated, CHEI. So this is the intro explaining what you have to do. Again, you are not an auditor. You're not auditing kind of in that kind of a capacity. So make sure that when you are producing a report, that it's constructive. And this is something that you will see throughout the presentation that they'll have to make later on in the process. That they're really going to look at whether your recommendations are constructive or not. Okay, so CHEI has approached CPS with a request to assist them with a strategic analysis and to set a new direction for the company, right? So what's interesting to me here is there's a new direction. So they're asking you to make a decision. CHEI is concerned with their ability to meet growth and profitability targets. So right away, I'm thinking this is your role. And this is a better explanation of what you have to do, right? So their end goal is to meet growth and profitability targets. And there's obviously some operational issues which they want you to analyze and address. This is a really high level discussion at this point. Okay. So let's go through and let me kind of explain the next couple of parts here. Company background. CHEI is a privately owned Canadian company, so private Canadian. Right away, you're thinking ASPE, right? Since incorporation, CHEI has only issued common shares. CHEI's organization chart is provided in the appendix. And if you look at this appendix, you'll notice that it's really, really complex. There's a lot of different staff doing different tasks. And right away, the thing that jumped at me after looking at this appendix is they're likely going to be a CCPC, but over the limit dramatically. Okay. They may not even qualify as a CCPC, considering that they have so many subdivisions here. But we're going to talk about that later on. And tax is really not a super important topic. Here at least, right? So we don't have enough information to be able to talk about it. CHI consists of a head office and two operating divisions. And now we know that there are really two parts. There's HE, right? And there's a homes division. HE executes heavy engineering and construction projects internationally and within Canada. HE's division projects include the building of bridges, dams, roads, and highways. Okay, so these are very major projects, typically with government funding, because governments own all bridges, dams, roads, and highways, right? The home division develops residential properties of various sizes with a focus on detached homes. Okay, so from an S&G standpoint, what you'll notice is these are vastly different businesses. Does this make sense? I'm not sure. Right away, I'm thinking there's a higher risk considering that you can't be a master in both doing bridges, dams, roadways, and then doing really small residential property projects. Okay. CHEI has a December 31st year-end consolidated financial information is presented in the Appendix 2. So obviously you have their financial statements. HE's division income is presented in 3. Homes is presented in 4. CHEI's head office does not charge costs to the divisions. Is this normal? You want to think about that. So from an intercompany perspective, should you charge costs to the individual divisions or not? Well, they would be eliminated as intercompany transactions anyway, right? But in order to assess, say, the profitability of one of the entities, wouldn't you want to assign the costs of the head office if you know that proportionally the head office does more work for one of the divisions compared to another? That's just something for you to think about. The head office is 2015. Financial information can be found in Appendix 5. Okay, so again, I'm thinking FR. And again, FR stands for financial reporting, intercompany transactions. I'm seeing some currency conversions. I'm seeing some subs. Okay, and we're going to talk about the subs. So speaking of the headquarters, including the divisional headquarters, which are in Hamilton, that's in Ontario. The company has local offices in some in Canada, some in America, in the United States, in Europe, in Asia, in Africa, and Southeast Asia, etc. The one that really interested me here was Yangon, Burma. Yangon, Burma is under a military regime. So I was very curious to see this in this case the first time that I read this, because Burma is a country that's known as Myanmar and is under a military regime with really rampant human rights abuses. So think North Korea, but kind of a little bit more civilized. That's kind of the levels of human rights abuses. So you have a Canadian private-owned company who's operating in Burma. Okay, right away, I mean, I'm thinking that there could be a problem. The head office building and the local office buildings are owned by CHEI Whole, and there's a long-term mortgage, and all the other offices are leased. So we're talking FR, we're talking different depreciation policies, correct CCA. From an FR perspective, also, we're thinking operating versus capital leases. So if it's a job site, why is it, is it an operating lease? Is it a capital lease? That's something they have to think about. CHI has several owned subs located in the US. I mean, we already know this because this was a paragraph above. Now, do you notice that they're scrambling some of the content? So for example, this sentence was really a continuation of kind of this point over here, but then they randomly threw in this point about amortization, which has nothing to do with the flow of the case. I mean, really, you could have just moved this up over here and then it all would have made sense. But unfortunately, this is what you have to deal with. So this is a really scrambled case, and I had a lot of difficulty reading it myself because of just how scrambled it was. Okay, this is meant to represent what a client would typically come to you with. Not all clients are super organized and have files ready for you to audit or review or to suggest, say in this case, how to improve on. So they're coming to you with what they've got. CHEI has, again, severally wholly owned subs, right? And we know that because they're private. But now we know that they're entirely owned, right? The wholly owned subs vary in corporate tax rates, with Burma offering the lowest corporate tax rate of 15%. Okay, so this is something that's really interesting. Is this a tax planning opportunity here? I mean, aside from the ethical considerations, is this something that you should consider? CHS head office does not charge costs to its subs. What's interesting is this is the same sentence that was mentioned above. Why are they continuously trying to push this? Because I think that there's some kind of a tax planning point that's relevant here. Okay, so then they pretend like, we literally jumped a couple of paragraphs because this sentence feels like something that was talked about 3 paragraphs ago, where they're talking about the general background of CHEI. It was founded in 1952. Now it's 2016 by a guy named Howard, a civil engineer, and he provided consulting services. And within a decade, his company was big and providing design and construction of dams and bridges. Again, do you notice that the type of business that's being provided here? It's not houses. CHI has received recognition within Canada. It's been family run. And since in 1999, the first non-family member CEO was hired. So from a strategy and governance perspective, we've got experience in dams and bridges, not houses and power plants, which is what they talk about later on. And then we jump in and we get kind of a description of their vision and mission statement. Okay. So what's interesting to me here was that the vision and mission statement was set up on different dates. I didn't quite understand why. Normally, you would have a vision and mission statement done on the same date, because in order for you to execute on, say, the vision statement, you need a mission statement. And in order for you to execute on the mission statement, then you probably want some kind of performance measures or goals, or right. So something that you can actually execute and determine whether something is effective or not when you're looking at performance measures of an entity. So from an S&G standpoint, as we're reading the vision statement, and let's read this together, our vision is to be the best medium-sized heavy construction and mid-market residential construction and property development firm in Canada. Now, first of all, I don't understand what it means to be the best. I mean, is this the largest? Is this the most profitable? Is this the concept of the definition of a vision statement is that it's a future mental picture. Is so, in my opinion, this needs a little bit more clarification, and you could possibly recommend. And I think that's what they're kind of hinting on here, that they want you to come up with a better vision statement that would meet the needs of their users here. The mission statement here is Canada Heavy Engineering Inc. maintains high standards in completing all customer projects on time and on budget, and in providing high quality homes for first time buyers and other customers who want competitively priced residences. Now, what's interesting here again is this is so strange. We're talking, so a mission statement typically contains three parts: the what, the who, and the how. We have all three parts here, but the issue is they're really unclear, because in this part, we're really only talking about homes. We're not talking about HE division at all. So unless they're talking about here the time and budget, but this could apply also the first time homes. So you want to think about, is this currently being met? And if not, how can it be improved? CHI faces several legal risks related to environmental issues, workplace injuries. So, so this is if someone gets injured, like on the job, property damage, project delivery, and project quality. But the company has never gone to court for reasons related to a contract or a project. Now, just because a company has never gone to court yet doesn't mean that they are not kind of subject to future problems, right? So, and this is what they're trying to tell you here. CHI has settled several employee dismissals in court. So you really want to get an understanding of what that was. And from an FR perspective, you want to think about, is this a future possible contingent loss? Is there any other dismissal that we're thinking about? So if your suggestion later on is to scale down the amount of employees they have, right? Just think that there might be a contingent loss, which you'll have to, which you'll have to recognize, because chances are that it will end up in court again. CHI has no corporate and environmental policies in place. That's really strange. Historically, CHI has ensured that it follows all relevant environmental laws in the jurisdiction where it's working. If any issues arise related to the breach of environmental laws, CHI's customers are expected to deal with these issues. Think about it this way. When you're working and doing business in a country with really significant human rights abuses and abuses of power, how can you expect the customers, aka the state, to deal with the issues? And you want to think about also kind of corporate social responsibility, CSR. From that perspective, this is your client coming to you and saying, well, we just let the customers worry about it. Is this a problem? That's the way that they're asking you this question. So as a consultant, as a management consultant, it's your responsibility here to talk about, does this make sense from an ethical consideration to continue doing business there? And how does it relate to future projects? If you notice, there's a really similar project that they're planning, which will destroy the land and basically remove about 3,000 people from their home. So you want to think about what is kind of, does this meet the vision statement? Does this meet the mission statement? How would Canadians react to something like this if they found out that that a company who's building their bridges and building their highways in Canada is engaging in really, really unethical behavior internationally, right? So, I mean, if you had to pick from two different companies, like what I'm saying is, do you think that the international concerns can burn up their bridges, for lack of a, in Canada? I think that that's really the case here, and I think their company might go bankrupt because you can have provincial partners who might pull back contracts because of their association with these really, really extreme regimes. CHI's bank requires audited financial statements. Carthy and Young CY has been appointed as the company's auditor since incorporation. And as you can see, they've got a really strong relationship, and they always receive an unqualified audit opinion. The issue is that they actually never visit the other subs, right? So that's what's kind of we're seeing here. So does this make sense? And I'm noticing another strange kind of topic here. I'm not sure if this is necessarily an independence issue or not, but CY prepares all corporate income tax returns as well for CHEI and all of its subs. So from an assurance perspective, the subs are not audited. There's an operational risk, kind of controls issues, reliance on information, especially if this makes up a really material part of the discussion. So you just want to think about that. I'm not saying that there's necessarily an independence risk or not, but it's just something for you to consider. So some investors might want the auditor to produce corporate tax returns. You also want to talk about and think about the relationship and the ongoing nature of the relationship. So CHEI's stated objective is to earn a 16% margin on revenues and to earn pre-tax profits of 7% of revenue. Corporate tax rate is 27%. The reason why these rates are important is they're almost hinting that you should be using some of these in the projects later on. What you'll notice is throughout this case, you'll find other discount rates that are mentioned. Their standard discount rate below, as you can see down here, is 15%, right? But above, the objective is 60% margin on revenue. The reason why I'm kind of providing you with a little bit more information here is you want to think about what is the appropriate rate. There's no problem whatsoever for you to suggest to use a different rate than what they are already using. They themselves, in one of the projects, are considering to use later on page 20 or something. They're using they're recommending in the board minutes to use a 20% rate. So you want to think about what is kind of the best rate. And the CHI also, I've kind of skipped over a couple of parts here just because it flowed better. But it pays an annual dividend at the end of each April based on the funds available and the outlook for the oncoming year. And as you can see, the dividends have always been generous, right? So tax, right? You want to think about the tax implications. That's kind of the part. From a management accounting perspective, if a significant number of contracts are losing money, is this really the best way to continue to provide dividends to the shareholders that are quote unquote generous? You want to think about that. CHI's board meets every second month, usually at the company's head office. The board has no committees under the terms of the company's project approval policy. All discrete projects or contracts over 40 million must be approved by the board. And you want to ask yourself, why is it 40 million? So from an S&G standpoint, lower could be better. You might want to argue for that. Where the board would be involved, according to a recent discussion. Again, this is the 15% thing that we were talking about earlier. And their board members are paid pretty well. $5,000 per board meeting plus $250 an hour for any work performed for the board. The board of each of the subs consists of one person who is the head of that sub. Okay? And the board must consist of 6 members who meet the following criteria. And from this perspective, from a kind of a performance measurement standpoint, you want to think about how are these board members and management evaluated The reason why it's tricky to have a bunch of people sitting on your board that are linked to your family is it's hard to fire your family compared to hiring a firing a third party. So think of kind of more of a balanced scorecard approach and make sure that people that are sitting on the board are evaluated in the right way. So what we're noticing here by looking at who are these board members is a lot of them are representing the family. There's only two independent non-family members here. Okay, so let's talk about who they are. Penelope is the chair of the board, and it tells you right away that Penelope lacks business experience. Considering that she's the chair of the board, this is someone who's helping vote on these 40 million and up contracts. So she keeps the board on topic. I'm sure she's really organized, but the thing that scares me is the person who's supposed to be keeping track of all the employees, all the board members, lacks business experience. That to me is kind of a scary point. Cece is a commercial lawyer, right? And she is a partner in Calgary. She's a commercial lawyer. The issue is I also feel like from an S&G perspective, she might be a little unqualified considering the amount of international law that this company does. John, retired CEO of an American company that's very similar to CHEI, and he's a civil engineer. So really, really good, but again, lacking experience with the homes division, right? So he's pretty good to help out with, say, the direction for HE, but not necessarily the homes. Frank, an investment advisor and a mutual fund salesperson. I'm not going to say that he's incompetent. I don't necessarily feel like he's totally incompetent, but they also don't share. They also don't sell their shares publicly. So, from a financial perspective, I'm not quite sure that this is the right board member to have for future growth. So you just want to think about, is this the right person? Independent board member, West Coast real estate developer who owns more than 70 properties. So this is the homes division tie. And this person I actually like because at least this is someone who is in the business of developing, right? So this is a perfect board member for the homes division. And there's another board member that has direct ties to politics. And something for you to think about whether you think this is appropriate or not from an ethical consideration. Head office. So this is now management. This is what they mean about head office. Let's talk about who they really are. James Johnson, president and CEO. He seems like he is quite competent in the HE side of things. And he's been around for quite a long time. My issue is he is likely to retire shortly because he's been with the company for a long time. So from a continuity perspective, he's got significant experience in HE, but not homes, but he's likely to retire. Kelly Mack, VP of Finance and Systems, is a person who, despite being the VP of Finance, doesn't actually have strong knowledge of Canadian accounting and tax, which is really strange considering that you're the VP of Finance, especially the systems as well. So in other words, this kind of sounds like financial accounting and internal controls. That's what they mean about finance and systems. One of the things that I want to kind of bring up here is that she was hired as the controller of the HE division in 2009 and then subsequently promoted. You want to think about whether this is the right person for a controller on kind of a certain board. I'm noticing just a quick comment that there's no CPA or CA on the board, and the comment is there's no CPA on this board, and it's a requirement for larger companies. There actually isn't a requirement for any private companies. I mean, could you argue, for example, Antonio, that there should be one? I would agree that that I would highly, I would recommend someone with with a current CPA designation to be on this board. That would be kind of key for me. Watch out for any from an FR and tax perspective. Watch out for any potential tax and reporting weaknesses. So right away, as soon as they tell you something like she admits that her knowledge of accounting and taxes is weak, no wonder they're asking you for advice later on. You know right away, even from the sentence, that later on you'll have a problem. And from an S&G standpoint, is this really the wrong person for him, for this position? Now, the tricky situation is, how do you communicate this to the board, and how do you communicate this to management? She is management. I mean, she reports directly to the board. Would you say you should fire Kelly Mack? See, this is where the challenge comes in with being a consultant. You can't say everything you want to say, despite it maybe being the right decision. So we all know that that's the right thing to say. Probably you should look for a different person than Kelly Mack. But to go back to a different point, you are a management consultant. How do you tell someone you should quit? I don't think that this is the right role for you, right? So this is the tricky situation with your presentations, and be really careful during your presentations later on during Capstone 1, kind of towards the end of this process. When you are making the presentation, be careful not to accuse and not to say things like, well, we need better staff, because you are reporting directly to the board. Okay? Zoe Murphy is a VP of Human Resources. She's been with the company. I don't really have a problem, with the exception of the 30-year argument here, because again, she's likely to retire shortly. 2 internal lawyers are based in CHI's head office. One lawyer works exclusively on HE. The other one does 60/40. Now, if you notice, that's basically 1.6 FTE, or full-time equivalents, for HE versus 0.4 FTE for Holmes. You want to think about, is this really appropriate? I mean, should you have more legal staff compared to the number of employees? And later on, we're going to look at the actual numbers of employees, which you can find here. From an HR perspective, you can tell that despite management, and this is between you and me, I wouldn't necessarily say that in the presentation, but something for you to really think about. Between you and me, I think the board and management is not quite competent, whereas they're claiming that human resources, the staff, are well-educated and loyal, and they appear to be more competent than normal. Okay. Now you want to think about kind of what this means. Managements don't receive overtime pay, but they're willing to work the extra hours. You want to think about why. CHI rarely lays people off, and when they do, they pay severance packages that are generous. So if you are going to propose to lay off a portion of the workforce as part of your recommendation, then you need to know that you're affecting lives, and you're going to have to pay out significant expenses from an FR perspective, and these would be liabilities, right? And they even tell you what they are. So in other words, if you wanted to say, okay, well, maybe you should cut down on the amount of management employees and reallocate some of the work, they're telling you how to calculate the expenses associated with that in your quant, right? Do you get it? Like, this is why they're giving you this information. None of CHI's employees are unionized, or either in the HE or Holmes division. There's never even been an attempt. Okay. And they're saying that they don't hire new grads. So this sentence was basically saying they don't hire new grads, and please do not tell us to hire new grads, because it needs more experienced people. Right? So in your presentations, don't say, please hire new grads. They specifically told you that they need more experienced people. Okay, that's why it's kind of like a hint that you should get from looking at this. Now, age distribution. Do you notice that 80% are 40 plus, right? And they say that people here retire early. This is something which you have to be very, very careful about, because from a continuity perspective, they already hire people that are quote unquote senior, right, and have more experience than others. And So that only gives them, say, 20 years, which they can have with one employee. So from a continuity perspective, you want to think about this helps you provide during the last year, 121 employees retired from the company, including 72 managers. This helps you estimate basically the future employees and when they will be retiring, right? So last year alone, they've lost 121 employees. That's huge. That's 10% of their workforce. So again, from a continuity standpoint, there's a huge risk. And CHI pays its employees salaries that are consistent with salaries paid by the industry. A manager can earn about 120,000, including benefits. A non-manager earns 65. So a little on the low side, I would say. CHI head office executives, including the CEO, are paid a total bonus equal to 0.4 of the consolidated net income from operations. So they have an incentive basically here to perform. Now, from an MA perspective, should the bonus be only tied to net income for the CEO and all the VPs? No, right? Because they have to work on a more of a balanced scorecard approach to look at both short-term and long-term kind of allocations of performance, right? So your recommendation could be structure it based on other types of performance measures, which would be really important. In the HE and Homes division, the executive team earns a bonus based on the individual's actual achievements. Okay, so why is there a difference? Right, so something for you to think about versus the targeted plan, blah blah blah. Executives can earn up to 7% of their base salary as a bonus. So for any of the division people, lower down, again, it's based on kind of some kind of a performance bonus, and obviously employees really like this because they are retiring early, and that's what we see in this case, right? So as you can see further down below, they're retiring at 60 years of age, considering that the mandatory retirement age is 65. And people in Canada in generally are working longer and longer. They are not typically retiring at 65 anymore. So from a continuity planning, knowing that people mostly retire, right? So this word many is a scary word. Many means, consider this in your continuity planning, that people will be retiring at 60. If they work later on, if they work kind of past 60, then it's something that's great, but you shouldn't be necessarily relying, considering that many of the employees are retiring by 60 years of age. Okay, a couple of control issues pop up here in the next paragraph here, right? So we see that the employees in North America are paid by a direct deposit. So direct deposit using a payroll service means very transparent income, right? Because you can trace back. Employees who are located outside of North America are paid by local independent payroll providers, and emerging economies are paid by bank wire. So there could be some kind of a risk of potential control failures, fictitious employees in these emerging economies. And what do they mean by these emerging economies? Again, we're talking about places like Burma or even Africa, right? So these are the emerging economies that they're talking about there. Over the past 3 years, many of the CHI's Canadian employees have complained about the uncertainty of their take-home pay when they've been posted overseas for more than a year. What does that mean? I think they're getting I think they're hinting on the unpredictability of the Canadian dollar. So, for example, if what happened in the past 6 months, for example, is the Canadian dollar dropped quite a bit. So if they're getting paid in Canadian dollars, right, because they're Canadian employees, they are all of a sudden seeing a 30 to 40% cut in their salary. And that's why they're complaining about the other aspects of living abroad, including these relocation costs and the international housing. Okay, internal control failures. I want to think about kind of what are the long-term consequences. What do unmotivated employees do? Well, unmotivated employees potentially create a problem with respect to you having poor execution on specific projects, and poor profitability of certain contracts. So think of kind of foreign exchange rates here, and think about the motivation of employees, the managers, right? And we know in this case that they hire a lot more managers because that's the kind of work that's typically performed. Because that kind of work is typically performed, if the management is not motivated, they're much more likely to not care about the overall project. Okay, let's look at the heavy engineering division here. The Canadian construction industry is estimated to be worth 170 billion. They talk about the number of firms. You can estimate where they're at. I think the point of all of this is to just explain the possibility of where this could go. The reason why they're telling you this is the industry is impacted by recessions and other economic crises, but as a counterbalance, many governments increase spending. So this is just a very typical Keynesian model of economics. So they're telling you that kind of on balance, governments will continue spending in kind of the HE division, right? But possibly not the homes. That's kind of the point here. But what happens if governments really run into a depression, right, and not a recession? So you want to think about that. EDC. There is this point about EDC where EDC is basically an agency, a crown corporation that's responsible for assisting with providing loans and guarantees for anyone trying to do business outside of Canada. They often also help with insurance and other guarantees, but the projects are limited to 100 million. You want this limit because you're going to consider projects later on, which you have to assess whether you're going to accept that kind of level of risk. And there's a couple of other vital pieces of information that you should know. And this is something that we talked about earlier, right? So there's this no bribery pledge as part of their employment contract. So obviously, they're requiring staff to behave ethically within Canada. But my concern is, despite there being a no bribery pledge as part of the employment contract, this can't really be enforced, especially in a country like Burma. So if there are bribes that are provided, how are you going to deal with this situation, and what are the legal liabilities? And if you are considering another project, say in Africa, which you are later on as part of this, what are the consequences from a legal perspective? Okay. This whole concept next is the workers' comp. And really, for me, I just kind of assumed that it was more of a financial reporting, contingent loss type of a consideration. And they're telling you that their safety record for HE at least is above industry average. I mean, it just really means that they haven't really had too many issues. But if they do, then it's a contingent loss, right? CHI has a number of large and small competitors. Many of the international contracts many of the international contracts are European companies, so they have a lot of European competitors. There is one Canadian company which is now the biggest Canadian company in the industry, growing by 14%. Thing is, they are public. So this could be an explanation, a qualitative discussion as part of your IFRS conversion discussion, right? Which was a requirement and assessment opportunity that I discussed in the beginning of this presentation, that you're supposed to talk about the IFRS. Well, one of the recommendations might be, well, look at DNC. So should you adopt IFRS? Well, maybe, because we think that it's going to be doing well for the overall company. Okay. And by adopting IFRS, you want to think about other things, right? So it's going to force them to improve the board functions. It's going to force them to have more stricter management roles with better evaluation. Let's talk about the history of the division. So this is where the additional risk comes in. Historically, they tell you they've been building dams, bridges, and roads and highways, but now they're going after building things like code generation, power plants, and they're now working on the refurbishment of a mine. So this is a huge risk from a management accounting perspective, considering that later on in this case, you'll notice that they're already doing kind of poorly with respect to running behind on costs. So how do you know that they're going to be able to actually go back, right, and do a good job if this is their first time running something like this? Their reputation is really on the line. There's a ton of competitors who are also dying for this business. From a management accounting perspective, you want to think about, do you want to continue doing this, right? Or do you go back to building dams, bridges, and roads and highways, which is what you've always done? Okay. CHEI realized significant losses on 3 projects. So the dam project, right? Because basically the blasting costs were lower. So this was a poor estimate. This was a poor job done by the estimate team, right? So from an FR perspective, that's an immediate write down. From an S&G perspective, that's poor employee training and selection. Potentially, you're hiring the wrong people. And from an assurance perspective, are these poor internal controls? Okay, and maybe do you remember this discussion about this dashboard? Well, maybe this is the kind of information that you should be including on the dashboard. So where are the losses, and where are the main issues, and what are kind of the estimates? Okay. Operations. HE enters into 2 basic types of construction contracts with customers. And to me, I read this as basically full risk versus limited risk. I don't know if you read this differently. Sometimes when they negotiate a price and there are extra billables, basically they try to do something called a change order. But the problem is this creates a huge reputation risk for them, because now they might not necessarily be invited back, and they might not be selected for future work. Okay, now they're telling you that basically all of HE's divisions are fixed price contracts. So they take on the responsibility. And that's why, from an S&G perspective, there's that incentive to manipulate the net income by taking on as many contracts in the short term, possibly misrecognizing revenue because you're getting money up front, right? Because of these billings going on, right? So CHI prefers to base its billing on predetermined dates. If you misrecognize the revenue, all of a sudden you end up with a huge net income. Therefore, a payment paid directly to their top level staff. Okay. From an internal controls perspective, you have $100 million contracts using a contract template. Possibly you might want to think about hiring another 2, 3, 4, 5 lawyers if you have 1,200 employees. It may just be worth it. And so CHI prefers to base its billing on predetermined dates or rather than milestones. So that's basically if the client falls short, they still get paid. So from an internal control perspective, it's actually good, but just again, look out for that revenue recognition risk. CHI's contracts also include a holdback. So there's kind of these holdbacks, there's these warranty periods, there's a maintenance bond. These are all different types of liabilities which you have to consider, right? So these are really complex. Basically, they're explaining the construction industry, but you should know that that these are just certain types of liabilities from an FR perspective. And you want to think about, again, do you mention some of these items on this dashboard? I mean, does management need to know what is, say, the total amount of holdbacks available, the total amount of warranties out there, right? So how much of a liability are they taking on with these warranty periods? Possibly you might want to evaluate management on that. And typically, they have these consulting gigs, and what I'm seeing here is CHI will rarely enter into consulting projects for projects that they would like to construct, since this type of involvement can result in CHI being ineligible to bid on the project. When I was reading about this point, I've noticed that there's a lot of points that talk about the same type of an issue here, where there are significant linkages to a broken bidding and contract evaluation system. So, from a controls discussion, there are a lot of examples of where this is a problem. Um, so, just something for you to think about. And I'm just going to probably stop at the end of this and take a quick break. But the very last point here is they tell you that in order to improve their competitive advantage, and to reduce feature maintenance costs, they've developed a certain predictive algorithm, right? So this is kind of that intellectual property of something that they created. It's something that you're gonna have to evaluate at a later point. So why don't we take a quick 5-minute break? I'll be back at 2:08 p.m. Eastern Standard Time. Meanwhile, if you have any quick questions, let me know. And we're going to begin with project execution over here and continue going. Hello and welcome back. I just want to answer a couple of quick questions. I'm noticing that a lot of the questions pertain to obtaining the slide deck, and some people are saying just kind of providing a couple of general comments that they're liking the debrief, and I'm happy that you're enjoying it so far. I will be providing a webinar link for a replay that will be emailed to you automatically if you are already enrolled in this webinar. So the webinar software automatically sends out a webinar link to rewatch this presentation going forward. So if at a later point you still don't get it after about 24 hours, please let me know and I'd be happy to manually resend. Regarding also the idea of the slide deck, a slide deck will be available. As soon as we're done the presentation, I will just simply forward this PDF with all of my notes in it, and you'll be able to print this, and it's also going to kind of look all proper. I'm not able to send out any information by email. I know some people are putting in their email address right into the presentation. I can't do it right at the moment. At the end of the presentation, I promise I will help you in actually obtaining this exact PDF document, which has all of my notes in it. So you can actually just print it out, and you'll have all of these colorful notes with you. Okay, so why don't we continue? Project execution. So here they're talking a lot about where are the projects located. So whether they're located in urban centers or not, they're telling you what the raw materials are. So if you notice, there's a lot of fluff here. They're telling you things like urban versus remote. Here are the materials. As an accountant, you know very little generally about how to build things with respect to being a professional building company. What you care about is the accounting implications of this. So let me give you an example. From a concrete, asphalt, and structural steel perspective, you care about the quality, and if the quality isn't quite there, then you might see a liability, right? So from an accounting perspective, that's what I care about, and from a management accounting perspective, that's really what I care about. I don't necessarily care about what type, what are the materials. I look for what can go wrong if these materials are not what they're supposed to be. And the concept of urban versus remote really means that there's a delivery cost that's associated with getting these materials to a remote location, which is why they provide you with that information. So then they tell you about the organization, that some of the more larger and complex projects have a project director who is accountable. And then there's a project manager. So it sounds like to me like these larger projects have multiple project managers reporting to a project director, right? And then they're supported both by a team of employees and contractors who may be. So the structure works because there's someone who's responsible, right? And there's people that kind of are accountable to them. Typically, the design and planning employees work at the head office while the supervisory employees are on site. My issue is why would the design and planning employees be always out of the office? To me, I kind of see this as a bit of an internal control weakness that you have to send out the planning staff to be on site, and these contractors are hired to fill the gaps. The issue with hiring a contractor is who is ultimately responsible. If a contractor fails to perform as required, CHEI still takes and bears the risk. They can later on turn around and sue the contractor, but they ultimately bear the risk. So the way that I see it is more contractors equals more risk, right? Which is why you need strict criteria for who these contractors are. Okay. Especially when you're talking about international staff. If you're dealing with these international subs, there's no WSIB. If a worker gets hurt on the job site with a large number of manual laborers where labor is cheap, could you be implicated in some kind of a human rights abuse? The answer is possibly yes, considering that the auditor doesn't ever travel there. Very few employees travel there. The planning people never travel there. So who truly oversees the international subs? Only the lower level employees, right? So there's an issue there because there is a really, really easy ability to abuse human rights. You want to also think about the actual usage of heavy equipment. So the subcontractors own and operate most of the equipment. So it sounds like to me like the subcontractors are actually coming with their equipment, and CHEI is more like the project manager, which is interesting. But the HE itself owns portable office sites, housing, light trucks, trailers, and measuring and various kind of measurement and monitoring devices. Now, you want to think about, is this the right way to structure something? So, should you recommend for the subcontractors to bring their own equipment, or is there a better way of doing it by hiring the subcontractors to perform the work using equipment that's owned by CHEI? At that point, that would change the depreciation method, for example, and that's when you would have, all these different areas. Plus, each one of these assets, right, the office sites, the light trucks, the trailers, would have its own way of allocating depreciation, which is why they're mentioning it here. Marketing, sales, and bidding. I thought that the staffing ratios are really, really strange here. 27 sales staff, 2 lawyers, 1,200 employees. Something isn't right. And these employees, these sales staff, are responsible for identifying and bidding opportunities within Canada and internationally. So does this seem then that they are also positioned internationally as well? It's unclear. And it's important to understand from a management accounting perspective, what guidelines are provided and how are the contracts calculated at any point in time. Because the bidding and the estimation team is really the most critical part of this entire equation. If the bids are not done right, they have the ability to lose money. What they do tell you is that they do hedge for currency risks, but only on projects, not necessarily for hiring employees. So they hedge their own foreign exchange exposure, but there's no word about employee compensation here. What's interesting is this paragraph here. CHI sales agent is Burma is an ex-employee who's been very helpful in securing contracts for the company. This employee has strong relationships with the Burmese government. While the commissions paid to him are high, he's been able to obtain construction contracts within Burma at overall high margins. You want to think about, again, based on what I've told you so far, is this a bribe? Is he bribing the government in order to obtain these contracts? So you want to discuss what are your ethical responsibilities here and what you should be doing. Again, we're seeing later on another type of a bond, which is again a liability and kind of also a revenue recognition piece, right? If we go down, they talk about their new website, which from an FR perspective is just a new intangible, right? So you want to think about kind of what this means, considering that this new site is actually resulting in 5 million of new business. Okay, so possibly maybe it's kind of an upgrade to their website that's required for their continued growth. Divisional management, they tell you about different kind of key employees. Again, you want to think about kind of this amazing employee that has worked there for 28 years, speaks so many different languages, and completed so many international projects. From a continuity perspective, this person's going to retire, but they're saying that there's a new president who's working 80 hours a week, and this is kind of the part about, does this make sense for him to work 80 hours a week, and is this a sustainable employee that can stick around there for a long time? I mean, how those of you that are coming here from a Big Four environment, how sustainable is it for you to work 80 hours a week on a continuous basis? Eventually, there is a chance that you might quit. Eva Jones is the VP Sales and Customer Relations for the HE division. She's focused on ensuring that the customers are satisfied. She's also evaluated on the total revenues of the division and these customer satisfaction surveys. So this to me feels like more of a balanced scorecard, but it doesn't include things like environmental factors. So I would recommend a balanced scorecard approach for all types of employees at all levels. Okay. Then we're kind of being brought into this argument where you've got two different employees that are responsible for bidding. One likes really kind of low bids. The other one likes high bids. This to me means that this process is broken, considering that there is no strict kind of guidelines available for standardized costing. So they should really be picking up only projects that they feel would um, would be profitable at all times, right? Instead of fighting over what they feel is an appropriate range. So, assuming that they run their numbers correctly, it should automatically just say, yes, we should be going with this project or not. It shouldn't necessarily be a huge range, right? Like these low bids, the concept of a low bid means that there is no formal process. And they're telling you about a new controller, and he's contemplating. Look at this word, contemplating the CPA designation. He's a controller, another controller at the at the organization that is not a CPA and has no accounting experience. It's amazing to me that this continues. So this is clearly a profound kind of problem, that they are continuously hiring employees into positions for which they're not necessarily qualified, for, and for you to think about. Then we're provided with more information on this homes division. So far, if you stop at this point, you can write a case about HE. There is enough information for you to consider here. The unfortunate part about this particular case is that they actually operate two different divisions. I think the second division is really confusing because it's not in line with what their main business is. The primary problem is this sentence over here. Many of the residential construction companies are small, privately held, and family owned. The reason why a smaller company might be more profitable in, say, something like home building is they have lower overhead. You saw the amount of managers they have working on some of these projects. I mean, it's hard to stay nimble. And this federal, provincial, and municipal governments have played an important role in the housing industry, and they're talking about these development cost charges, DCCs, and other fees. What this means is, and they're really explaining to you that there are fixed costs and sunk costs that are pumped into every project, regardless whether the home at a later point is ever sold. That's what this means. So the city makes money regardless of whether the land is used or not, and later on resold to a customer. So this is an increase in the risk. So for example, if a builder takes on a substantial amount of risk, building and developing something, the municipality gets paid, the original landowner gets paid, but if the builder is unable to, at a later point, sell, right, which is why they're telling you about economic cycles and interest rates, they're stuck holding something that's not worth that much money. But they are telling you that homes are increasing at 4.4%. And really, the reason why they're telling you this is they want you to build a DCF, a discounted cash flow analysis, and use 4.4 as future growth. Okay, if you notice, they're looking at kind of the future forecast here. It's stable, but there's no real kind of future growth going on here, right? So the prices might increase, but the inventory is not really, right? Which is why you might want to argue that from a price perspective, the prices are much more likely to be even higher, considering that the demand continues to increase while the number of new starts is pretty flat year over year. This is what you're experiencing in various parts of Canada today, where there's just not enough new houses. So you've got an article here that talks about housing boom may be ending soon. And you really want to think about what this actually means. It's really important to look at the new housing starts, because that's really kind of the metric that I think you should be looking for. Homes division. They're talking about the homes division. And, as I'm reading this, I'm thinking they produce all sorts of different projects, including one project that only had 11 homes. 11 homes is way too small. There is absolutely no ability for them to be this nimble with this sized with this size um, to I mean, the homes division can be extremely risky compared to something like the HE division, right? Just really because the size of the projects, um, just their just their fixed overhead costs might be the entire kind of cost of building these homes. Okay, and they have told you that in the past they have lost money if there are significant slowdowns. So on one hand, if you're suggesting, oh, I think you should really drop the HE industry and go more into homes, well, it's great while homes is booming, but at a later point might create some serious problems. Okay, operations. The homes division carries out business under the brand name Advantage, right? And there's this warranty. So from an FR perspective, that's your liability. And your key success factor is land, of course. But the issue is that they're running out of land and they're trying to determine and find a way to find cheap land. And the idea is to minimize these DCCs, right, to remain profitable. And then they tell you about different types of homes, where they talk about how many homes are typically built. And you want to think about, why is there such a discrepancy? Why is it 5 homes versus 8 homes built on 1 acre? You want to think about whether there's a better way of building. So they now, at the top of the case, told you that this is a company that primarily builds detached homes. Well, what if there's a better way to build? And if you notice, they do have quite a bit of experience building um, building things that are significantly more complicated than residential real estate, which is just built out of kind of basic wood, right? They build these bridges and dams, and right, these are very complex projects. They might want to think about going after more density, building condos, right? You can, given the fact that basically land is scarce, you might want to think about something that has multiple units on the same amount of property. Just increasing density. They tell you that there are basically 9 different plans, and from a finance perspective, calculate and tell me which is the most profitable. And then they tell you that customers are offered a selection of trim, flooring, carpet, cabinetry, etc. So upgrades. You want to think about from a revenue recognition standpoint, should you charge extra for higher end finishes as a way to increase revenue? If not, why not? If yes, what are the options available? Construction. This is an interesting point. They want you to make a decision on their behalf and conclude from an enabling competencies perspective and from a finance competency whether they should build finished homes or partially finished, the foundation and frame. And you just need to make that decision, right? That's really what they're asking for. And again, when they're talking about the type of subcontractors which they hire for homes, they tell you things like that they're required to perform specific services such as surveying, excavation, bricklaying, paving, plumbing, landscaping. So they basically installed the entire house and they supply their own equipment. So who's responsible for this equipment? Right? And some contractors supply their own materials. In that case, who is responsible? This to me screams that you need a sales flow and better internal controls and a better way to measure the profit on each of the houses. So you want to think about putting together a quantitative response, looking at the profit on each house sold, and to provide me with a decision on and kind of direction made. And I want you to supplement this with qualitative. So why is kind of a smaller house with less profit better for you? So maybe from a marketing perspective, you might be able to access more consumers, especially considering that they are in the business of selling to first-time home buyers, they might be able to attract more people with a lower sales price. So if they offer at least one home at a lower price, they might be able to at least get people to come into the door. That's what a lot of builders do. Generally, it takes 5 or 6 months for the homes division to finish. And they tell you this, that foundations cannot be dug. And really, you're looking at, from an MA perspective, cyclicality. So really, you can't start, quote unquote, any house in the winter. So you have to make sure that you have a really thorough process. Otherwise, you're going to have gaps in a year, right? Just something for you to think about. And they're telling you that this is basically the liability that you have to accrue for based on the revenue for the warranty costs. And they're telling you that it's generally been accurate. And you want to think about, even if this is accurate, is this better than industry? Is this worse than industry? Should you hold management accountable for this percentage? Is this something that may go into your dashboard, right? Remember how we were talking about the dashboard earlier? So what is this percentage that's used, for example, the actual warranty costs, right? If I'm noticing that there are significant problems, right, with a block of houses, well, maybe we should be looking at a different way to build. Sales and marketing. What was interesting here is, to me, I found this really, really hilarious. That CHI now provides another service where they provide initial financing, financial advice. I don't quite know whether this was a typo in the case and whether they meant to say that their partners provide, so these mortgage brokers and financial institutions, etc. But I mean, I'll just read it the way that it reads here. But it says that they actually provide advice and then refer people to specific banks, right? That's kind of the way that it kind of reads here. I would think that it's the opposite, that it's the banks that are referring the clients, right? But you want to think about, is this kind of ethical to refer them to a preferred lender? And what is the relationship there? There could be an independence problem, but in a private company setting, it's probably not an issue. But if they are getting any kind of a kickback, say from the broker or the institution, then by law, legally, they have to disclose. Okay. And here's this referral program that I'm talking about where they are basically referring. It's something that they may have to disclose. So they do pay a $1,000 referral fee, and I'm thinking, is there a way to increase this fee in some kind of a way, considering that it is working quite well? And a recent sale of 17 units, that's a substantial component, 25% of a unit development was sold through this referral program. So maybe that's really the way to go. What's interesting about the next paragraph here is they talk about the model home, and at least considering that the homes division is a block of different types of developments all over the city, there's one model home on each one of these blocks. So there's quite a few of these if you consider how many houses they actually have. What they tell you here is these model homes are sold at a small discount. Does this make sense? A model home typically has the most features. I mean, it's a marketing tool that's usually used. They would, naturally outfit it with all the various possible bells and whistles that are available. Should you sell it below cost at a small discount? I would say no, considering that from an accounting perspective, you've already paid property taxes on this property while you were waiting for the other houses to actually sell. So the actual cost that's built into this house is probably substantially larger than even the selling price at that point. So why would you then sell it at a discount if that's kind of the last piece of property you have? Right? I'm just thinking that it doesn't have to be sold at a small discount, but maybe I'm kind of being a little too picky here. And the divisional management team. Okay, let's look at the actual divisions. So Kirk is the president of the homes division. Basically he was a director in HE. Then they moved him into an area which he knows nothing about, considering that he's a civil engineer and was building really big projects. They moved him into homes. And what's even more interesting is before he went into project management, he was doing a lot of defense work, right? So basically, the weapons industry. It's not quite clear that he's totally competent for the homes division to me immediately, right? Um, Gene Taylor is the VP of construction, and Gene kind of deals with these day-to-day pressures. And they started their career as a carpenter, not necessarily as kind of a senior role. And the challenge that I find here is a carpenter is very much a doer. I'm not saying that they're not qualified from kind of a knowledge perspective, but there would have to be substantial additional education that would be preferred to any employee with a similar position. So you want to think about, again, continuity. Then you've got these approvals. So Gene ultimately has the approval on expenses, so on all numbers. So you have a carpenter, someone who is not necessarily someone who knows all of the information possible, who's doing all this work. That's related to approval. So I would think from an S&G perspective that there is poor governance here. And the next is the VP of Sales and Customer Relations is actually an interior designer. Again, third unqualified person. You have a designer doing sales. Fourth key employee, also unqualified because they are studying to be a CPA. Now, a lot of you are studying to be a CPA. I'm not saying that you're unqualified, but to work in a controller in kind of a huge scenario where you've got really significant revenues, I would probably imagine that there is opportunity for you to say hire someone with direct experience in the same industry, especially if you're pushing through that many, right? And one of the things that I want you to kind of consider here, you've got divisional stats here. Everything else is kind of interesting but pretty stable. The one line that is really obvious to me, right? So you've got fluctuating profit. You've got the one line that I really care about is the decreasing reserves of land. So clearly they're much more profitable on the idea of kind of building houses. And that's what we'll see later on. We'll see a lot of profit allocated to the homes division. So clearly this is a cash cow for them. But the cash cow is about to end if they continue down this trend, right? So there's a really steady decline in hectares of land. And as you notice, the four key executives, this is your poor tone at the top. These are the people that are really weak with respect to executing. And they drive all 188 employees. So all four people to me are unqualified, and yet they lead this entire team of close to 200 people. There's a huge problem from an S&G perspective with poor tone at the top. Okay, so when we get to page 16, they immediately start talking about something which to me looks like an isolated component. They call it information systems. And then all of a sudden they talk about an IT system. And to me, an IT system immediately means either assurance or management accounting. And this looks like a standalone piece. The rest of this case looks incredibly jumbled, as if someone took a blender and kind of hit pulse and spit out a bunch of information back. Whereas this is a neat presentation. In addition to the other internal controls that I mentioned so far, they also have this system, and they identify when it was implemented and how it works and that there are problems. Basically, this is a classic WIR, weakness implication recommendation discussion, and you want to think about what some of this stuff means, that they're able to process checks. So the idea is really weak internal controls. Then they talk about ASPE. They're currently using ASPE. Potentially, they want to convert to possibly IFRS. What does it mean? This is the information that you should be using for the IFRS discussion. Okay. Then they talk about this dashboard, right? So divisional income based on the continent, based on the roads, highways, bridge, dam, and then other types of project. And I would want a little bit more comparability throughout this entire discussion. I'm just seeing kind of a question out of the corner of my eye. I apologize. I know I'm skipping quite a few questions. It's just hard to integrate some of the other questions into my discussion. I promise I will get to them. But there's a question that says, how do you tell the board that you're presenting to that they are not qualified to do their job? And to be honest with you, that's one of the most challenging things that you can suggest as a management consultant. My recommendation here is to explain it to you, and this is all about then the enabling competencies, the general communication skills, where that's the most important part of your effective communication and how you communicate that information. My recommendation would be to not necessarily blame, but identify areas of kind of problems and say, here's how I would recommend to improve. And the idea is for all of us to be on board for future continuity, right? So we both want this company to succeed. I am noticing that there's a problem here, and here's what I would recommend. So if you express concern without providing a recommendation, that's improper communication. If you provide a recommendation and present the findings fairly, then that to me is proper communication. But they should generally know that there's a problem. Okay. The CEO and the presidents of HE and Homes Division also review this dashboard. And again, I'm thinking, let's talk about liabilities. Let's talk about environmental concerns. So these are the performance measures that I would want you to include. And again, they are forcing you to think about what to add in. Okay. Then they're talking to you about their annual budget process. And this is very much kind of a management accounting perspective where you're trying to calculate the number of projects that are used from year to year, and they want to be able to compare, obviously, to see where they're at. So maybe a lot of this information needs to be more standardized, right? So I kind of put here, number one, you need a standard reporting framework for comparability purposes, right? So maybe all the projects need to all kind of work in the same way for you to be able to even compare them. And number two, then allocate our responsibility manager to each of the projects. So then they're responsible and held accountable for all the areas. And to me, I did not see an issue why this can't be done automatically by SAPI, right? Which is their IT system. Considering the amount of revenue they have, they should be able to, hire someone competent enough to provide them with this type of level of reporting. Okay. Then they show you kind of areas of management oversight where they talk about kind of some of the areas contracts being canceled, and there's project revenue that's not been recognized, and they tell you about what that means, right? So this is revenue not yet recognized. So the sales price of homes contracted for sale, but not yet completed, and they tell you what that means. What's interesting is projects appear to be getting closer to quote unquote completion, right? So the number of revenue for the HE division looks like it's dropping. So they are recognizing more and more and more revenue, or they're taking on more projects, right? Because they're not taking on new projects. So think about what are the reasons why the revenue would be dropping from a revenue being not yet recognized, right? So that's something that you want to think about there. Budget. Okay. So finally, they talk about income. Like I mentioned before, homes is a huge cash cow for them on a percent basis. This is the problem division. So the homes problem is they're running out of land, and it's an unsustainable operation because once they run out of land, they're done. Or if the economy if the economy experiences a hiccup, then people are not buying houses and they're stuck with crazy amounts of liabilities. and expenses in that year. So this should be their main line of business, and this is what they're really living off. But the problem is they have a number of really unprofitable contracts, and their pre-tax net income is only 4.5%. So to me, you can't pay a hefty dividend to the board and management and shareholders, considering that shareholders are ultimately responsible for the board, right? The board is ultimately responsible for management, right? So the shareholders should hold everyone accountable to poor performance if that 15% benchmark before is not being met, right? So maybe that's the way to present the argument, that if you want to continue providing great service to your shareholders, then you should be considering streamlining the process. Otherwise, there is a chance that the shareholders might fire you from your director positions. So then they talk about kind of an operating line of credit, and they have 50 million credits, and it's backed by specific receivables and inventory, etc. They tell you about a pretty low rate, which is pretty good. This is really dangerous from a management accounting perspective because there's a cross default clause, which triggers an immediate repayment if there's a default on any type of loan. So the situation really is urgent. If they default on one loan, they're done. They're finished. Unless they have the cash to really support it. And the bank is willing to actually provide them an additional 80 million above their 50, right? But the criteria is based on what percentage of completion is the land, which takes the risk off the bank. So it's more preferred to buy kind of more developed land. So maybe when they're looking for land to purchase, they might look for land that's closer to completion, that already has all the zoning and has all the electrical and kind of water already connected, so they can borrow against a higher amount. A couple of other really interesting things. Their professional liability insurance is only 50 million and has a 2 million deductible. Does it make sense to have 50 million only when they have so many different projects? I think it's inappropriate, and I think that number should be substantially higher. A couple of little things. Then they tell you other information. The provincial government's running out of money. And this is something that I would recommend to add to your finance discounted cash flow analysis, that basically starting in 2017, there might be a decrease in government funding from the HE perspective. This sentence that talks about customers being unhappy is more from an FR perspective, that generally speaking, some customers might be unhappy. And again, that's a contingent loss. This paragraph to me jumped out where they're talking about it's a subsidiary in Burma that found a way to strengthen bridge footings in certain conditions. And they're telling you that the methodology is now used in all CHI projects where similar conditions are found. Now, but what I thought about immediately is how many bridges like this already exist? And is CHI ultimately on the hook for the old technology? So that would build a liability. And this technology surely is then worth something if it's an improvement. So I would think that on kind of the opposite hand, you've got an intangible asset here, which they can control. But can they really control this asset, considering that it's located in Burma, considering that this technology is located in Burma, which is an unstable regime backed by the military? So this goes back to the very definition of what is an intangible asset, right? Because it all goes back to control. So something for you to think about. In March 2015, CHI won a 7.2 million bid to win a project in Northern Canada. Received a great deal of obviously attention. There's a huge net loss. They're asking you from a financing perspective, what should we do? So this is one of the decisions from a financing perspective that you have to decide. Now, this is a clear finance quant. You have to figure out whether it's profitable or not. Okay, it's probably going to be unprofitable. They're telling you. But from a qualitative perspective, they're telling you something else here, that it received a lot of media attention. So that's something that has to do with the link to other projects that CHEI is doing, and how is this going to affect the other future work. So from an FR perspective, recognize this loss immediately, and from a tax perspective, I want you to think about, when do you recognize a loss on a contract, right? It's when it's incurred, not when it's estimated. And Miami office in Africa opened in late 2014. They're setting up a business, and they're seeking business in the area. They're funding it through a transfer, and I'm thinking what controls are in place to make sure that it's actually being spent in the way that it's supposed to. Another control weakness here is that they found invoices that are equal to kind of split between two different sets. And basically, to me, this read as either an invoice that's being billed twice, or something that's being authorized by one party. So it goes unnoticed and does not meet a particular threshold. Okay, so at the end of this case, you have this board meeting dialogue, right? And I found it to be really directed, right? So they're basically telling you, you need to decide whether we should do the following things. So to me, this point 2 and 3, consider the 4 new projects, discuss ways of making the company more profitable. Those two are clear assessment opportunities. Considering the new Euro bank account for the Canadian company, and any other business, are hints to other specific opportunities. They also talk about the different projects which they want you to evaluate, right? The Awani, the Klang Bridge, the Highway 507, which is a funny kind of play on the 407 if you're from the Greater Toronto area, which was a highway that was sold off to, or partially sold off to, a different country, and a land development opportunity called Bellman Track. Okay, so all of these opportunities will have to be decided on, in addition to anything else that you do. Now, if you look at this perspective here, they're concerned that they're not spending enough time planning. This is an indication that there are significant internal control problems. And considering that you're considering these projects, you should only take them if you feel like you have the right resources. And then they talk about why it's not the right resource. So, for example, the the public-private partnerships. There's issues with highway kind of toll system collection issues. So you'd be getting a cut of these collections for a specific amount of years. Then they get into more details about one particular area. Now, the Awani bit, if you're noticing, a target profit margin of 32%, but this is more of kind of an ethical consideration. So on one hand, the numbers here in this project will make it seem like this is the way to go. I think it's going to be a great project for the company. But from an ethical consideration, from a qualitative perspective, it might actually kill the entire business if the company is associated with something like this. Now, I also want to be very, very clear here. Before I start reading this page, my intent is not to solve the case for you. My intent is just to highlight the issues that you're going to talk about as part of your groups, and help you brainstorm other potential areas that you haven't really thought about. This project is probably likely to take about 2 weeks of a group's time together. So I don't actually anticipate myself doing this. I'm happy to review other people's submissions at a later point. And really, this is just a guide to make sure that you're not missing key areas. So I'm sure that you already probably know this. I'm not going to be diving directly into the exhibits and ripping them apart. The most challenging part of this entire case to me is the scrambled preamble near the beginning of this case, which is the first, say, 20 somewhat odd pages. And that's really what I'm trying to help you understand. I'm not necessarily sitting down with you and solving everything, right? Because again, it's so complex. Um, a couple of other things. So they talk about share evaluation, that it's at a high risk. They talk about using a different percentage point, a different return. And you want to discuss whether this is appropriate or not. So on one hand, this is an assurance discussion because it kind of talks about, is their contract estimation system valid? Is it picking up the right return? Because on the way out, they're not seeing these type of returns. The reason why you're expecting, say, a 20% return typically is because your expectation is to actually recover that amount going forward. If you're not seeing it, then there's a problem. The reason why they're telling you 20 to 30 years here is from a finance component. They're asking you to really do a discounted cash flow analysis for 20 to 30 years, but not longer, right? Which is why they say after which point many of the variables will change. So they basically want you to limit it to that amount of time. And at that 20 or 30 year mark, it'd be just like a breakaway point where you should just calculate into infinity. A couple of issues here with respect to the kind of political environment. And again, you want to think about from a qualitative perspective, how is this going to affect your overall public opinion with the Canadian government? If you are considering really significantly unethical projects. And from a consultant's perspective, if you advise this company to consider, say, taking on the Awani Dam project, which has significant issues with respect to ethical concerns, what does that mean about you? And are you acting within the best interests of the profession? And are you suggesting something that's within the member rulebook? Right? So are you recommending something? Are you behaving ethically yourself if you're providing advice that is not ethical? So that's where the qualitative angle, despite them earning a substantial amount of money, right? 32%, can you realistically provide them with the advice to continue? The answer is no. They're also kind of talking about, well, there are significant risks to working in a developed country where heavy equipment and travel is involved. So what they're really saying is, from a qualitative perspective, are my employees safe in a country where we're doing something unethical already? Right? And it's something for you to really think about. Then they talk about this whole piece about internal auditors. They want to determine whether an internal auditor is kind of, is something that you would consider. And of course, the answer should be yes. I'm surprised that a company this big does not have any internal auditors on staff. But you want to explain what they should look for with respect to an internal auditor. And possibly this could be someone with a designation. And I would strongly encourage that to be your answer. Then they talk about a couple of different things about kind of where they would hire this person, the Awani Dam, that even the EDC, the Government of Canada, was nothing to do with it, right? So it's kind of supporting this unethical theft of land. So then they're talking about that one of these directors is looking to sell their shares in 2 years. So clearly, from a user impact perspective, she wants to maximize the share value. So any decision that you provide her, she will not be, she's not going to be interested in any decisions that will remove value from the company. So all of, be careful during your presentation, because this person clearly has the intent to do anything possible because of the short-sightedness of her departure, right? Because it's only really 2 years at this point. Kathy, she's suggesting a piece of land up north. Do you buy this piece of land or not? provide me with the quant, also provide me with the qualitative. It's worth 70 million. You want to think about whether it's in line with a mission and vision statement, and decide whether it makes sense or not, right? So I would first update the mission and vision statement, then make a decision whether the land is worth it or not from, say, a finance perspective, and then conclude appropriately by looking at the quantitative and qualitative perspectives. I'd like to engage. So this is the official engagement. Again, we're talking about the internal auditor piece, right? So I've already mentioned that you have to talk about that quite a bit. Then they talk about what are the financial reporting and tax implications, right? So again, I've mentioned that as part of my assessment opportunities up front, and then they talk about IFRS. Well, maybe adopting IFRS again will be good for continuity going forward. And you can also recommend that possibly by adopting IFRS, the share value will increase because there's going to be more of an opportunity for people to bid on the shares. So I would produce not only an accounting discussion explaining the differences between accounting standards for private enterprises versus IFRS, but also kind of a general discussion of the qualitative considerations. Should you do this decision or not? Now, another scrambled thing into this one sentence. I mean, literally, this one sentence has 4 different topics. It has FR, it has tax, it has IFRS, and now it has this proprietary nature. I mean, wow, we just read sometimes an entire page with nothing on it, and now there's one paragraph that has 4 things. You want to think about, again, how do you measure the value of an intangible asset in a military state, in kind of an unpredictable economy, and whether you can truly control it or not. Then there's this concept about performance measures, right? This is a repeat of what we saw a couple pages ago, and they specifically want you to also consider tax. And we're done. Okay, so this is the end of the case. Then we've got a bunch of appendices, and I'm not really going to go through them because they're pretty clear. And this is where this is the point where you now have to sit down with your group based on what you've learned today and to decide what you're going to do in each of these cases. Well, what I will say is it's been my experience that you're not required to produce the quote-unquote right answer. There's often no one right answer. No one can predict the future and say exactly what's going to happen. My recommendation for you is perform an analysis that's thorough on both a quantitative and qualitative side. And while considering your ethical responsibilities as a CPA, provide the right advice. Do the right thing. Do you think that they should be moving along with specific decisions? And when in doubt, make sure that you're focusing on all of the key areas as I've described above here. One sec, I'm just going to exit this document. Right? Remember how we talked about the different assessment opportunities? Make sure you talk about all of these assessment opportunities. They are really going to be important. And I would divide up the conversation into kind of a more thorough discussion that talks about all of these issues. Now, I had a couple of questions that people asked me throughout the presentation, and even prior to it, there was a little comment box where people left a couple of questions here and there about what they wanted to see out of this presentation. And some of the comments were very interesting. I also want to give a shout out to Jesse, one of my old coworkers from the AGO. Hello, if you're still on here. I just want to talk about kind of some of the other questions that were mentioned throughout this. Now, one of the questions was, how does this compare to the CPA way? The CPA way is a format that CPA Canada uses to write cases. I find it personally to be generic because it doesn't actually dive deep enough into each individual case. So what I tried to do here is to consider all the aspects that I thought were important, and to rank them, again, from kind of my background. I wanted to provide as much information as possible on the assessment opportunities, and then to work backwards to see how we can find them within the case after we understand what they are. Okay, so now your job is to first take a look at the assessment opportunities, and then to move along with your groups and find a way to divide up the information, and to tackle the requirements of the 3 submissions plus the presentation. Okay, I'm just going to sum up the presentation with a couple of more things. Why PrepFormula? So I'm going to talk a little bit about PrepFormula for those of you that don't know what we do. PrepFormula provides students with an option to work with a qualified and currently practicing CPA with professional marketing experience on a one-to-one basis from now all the way up until the CFE. And we provide full summarized study notes, video lectures, and a customized schedule for each exam. We also provide a full case database and multiple choice questions for each exam. This is more relevant for the cores and electives, but I just thought that I would mention it anyway. And we do provide a T2202A that covers the majority of our program fees, so you'll receive a refund on your taxes after you purchase our program. And we did have an 89% pass rate. I want to introduce you to our 2016 CFE Prep program, and what we offer, again, like I mentioned, is a dedicated mentor from now up until the CFE. The mentor is a recent CPA marker and/or facilitator. With this mentor, you'll have one-on-one coaching sessions helping you write better on a one-on-one basis. We provide professionally double-marked practice cases, a personalized schedule for each module exam and the CFE, an objective format question and case database, like I mentioned, full summarized notes, videos, and full technical material summaries. And I have mentioned that we are the largest CPA prep program in 2015 based on site traffic, based on October 2015. And we do provide full Capstone 1 and Capstone 2 assistance one-on-one, helping you with all sorts of submissions as part of the program. And we do have a pass guarantee as well, that we provide students access to, ongoing access to all of our materials until you pass. So even if you're unsuccessful the first time, you will continue to have our materials the next time. What I'm going to show you is our early bird pricing. So until January 31st, 2016, we have 2 packages, one called CFE Prep, one called CFE Prep Plus. You can either purchase them at the full price or break up the payment into 3 payments with no interest and no additional fees. And you can divide up any of the packages into affordable payments. The content is the same like under both, but the difference between these 2 options is the number of one-on-one sessions and the number of marked mock exams. There's 3 in the CFE Prep, and there's 7 in the CFE Prep Plus, and also 7 marked mock exams. Okay, if you have any questions whatsoever, I'm just going to answer a couple of questions by using the live chat directly. So I'll be typing. I won't be verbally providing the answers, but I will be typing in the chat. At this point, I'd like to say thank you very much. If you want to reach me directly, here's my email address, mike.katsevman@prepformula.com, or you can call me on my direct line. Thank you very much for attending. You can request a copy of the annotated PDF notes that I've mentioned during this webinar by emailing education@prepformula.com. If you have any additional questions, feel free to let me know. And again, thank you very much for attending. The Q&A period will begin now, and I will be taking your questions.